Welcome to Blue Hat Bookkeeping's Tax Insights. I'm Andrew and I'm here to simplify a topic that could save you thousands of dollars each year, understanding the difference between repairs and improvements. Whether you're a seasoned property owner or just starting out, mastering this distinction can dramatically improve your bottom line. Let's get started. Did you know that misclassifying a repair as an improvement could cost you thousands in taxes? Many rental property owners struggle with this, but it doesn't have to be complicated. Today, I'll guide you through the key differences, common mistakes, and real-world scenarios to help you keep more of your hard-earned money in your pocket. So, what exactly is a repair? Think of repairs as the things that keep your property running smoothly. They restore your property to its original condition. For example, fixing a leaky faucet or patching a small hole in the roof. These costs are deductible immediately, which means you can claim them in the year you pay for them. It's like a quick win for your cash flow. On the flip side, improvements are investments that make your property better, stronger, or adaptable for a new use. They add long-term value. Picture this: you upgrade your entire HVAC system or add a new bathroom. These aren't expenses you can write off all at once. They get capitalized and spread out over several years through depreciation. It takes longer to see the benefit, but the value adds up over time. Now, let's talk about a tax gem called the Minimis Safe Harbor Election. This rule allows you to deduct certain expenses immediately up to $2,500 per item or invoice, or $5,000 if you have an applicable financial statement. But keep in mind, it doesn't apply to inventory or land. This rule is a great way to keep smaller expenses from being bogged down in depreciation. Now, let's address where property owners often trip up. For example, patching a few leaks in your roof, that's a repair. But replacing the entire roof, that's an improvement. Similarly, swapping out one or two damaged windows might count as a repair, but replacing every window in the property is an improvement. And that kitchen remodel you're planning, almost always an improvement because of the value it adds. When you have improvements, understanding depreciation periods is key. Furniture and appliances typically depreciate over 5-7 years, while residential rental properties stretch out to 27.5 years. Commercial buildings go even further at 39 years. Knowing these periods helps you plan expenses and understand how much of the cost you can deduct annually. Let's make these concepts come alive with real-world scenarios. Replacing worn carpet with new carpet, that's a repair, but upgrading to hardwood floors, that's an improvement, longer value, but capitalized. Fixing a broken section of your fence, repair, replacing the entire fence with a taller, sturdier version, improvement. Building a new deck, improvement. Replacing a few damaged boards on an existing deck, repair. By understanding these differences between repairs and improvements, you can make smarter decisions for your rental properties, maximize deductions, and avoid common tax pitfalls. It's about being strategic and knowing when to take short-term wins versus planning for long-term gains. If you found this video helpful, don't forget to like, share, and subscribe. And if you need expert guidance to manage your rental property expenses, reach out to us at Blue Hat Bookkeeping. Visit bluehatbookkeeping.com or book a call using the link below. Let's make sure you get every deduction you deserve. Thank you for watching. Your rental property isn't just an investment, it's a wealth-building opportunity. Let's make it work for you. See you in the next video.